The stock market was up a lot today. All of a sudden, the charts look very different. Is this the beginning of the next bull market or just a setup, a bull trap? What does a bull trap look like? This goes back in time, S&P 500. After a precipitous downtrend, we do tend to see bounces along the way. And notice what happens. When support is broken, it oftentimes becomes new resistance. A bull trap is completed when we have a sharp move to the downside. So the question remains, what are the charts now telling us? Is this the case? Here's the S&P 500. We're in a range-bound market for quite a long time. Had a big sell-off in March and April. Now we've come all the way back. Now notice that 5,900 level. That was approximately big support. It now looks like it's new resistance. The market looks like it's testing the lower end of the former trading range. How about the Dow Jones Industrial Average? It's a very similar pattern. We can see 43,000. That was a very big support level that was subsequently broken, now representing new possible resistance. Here's the NASDAQ, technology based. That looks like a head and shoulders. In fact, 18,700, that's the level that represents the first shoulder and possibly the second. Also, former support, maybe new resistance. And here's the Russell 2000, the small cap index, another head and shoulders. The key level here is 2150, which once upon a time was support, now resistance. In all four of these indices, we can see that key support levels are broken. So the question remains, will the market re-enter the former trading range? In fact, will we be able to break out to new highs, or is a big reversal back lower a bull trap in our future? Well, March 3rd is a very important day. That represents the breakdown. Here's the S&P 500. Now we did break down. That was March 3rd. That was the big level at 5,900 that broke down. Now, if history's any guide and support becomes resistance, 5,900 should be a stopping point for the market. However, if we do break above 5,900, that could be an early signal to the next leg of the bull markets. Now, here are some signs of a bull market, third-party confirmation. These are the Fed funds futures going back to January, specifically the probability that the Federal Reserve will not cut rates in June. This is no cut in June. Notice on March 3rd, we had a 20% chance the Fed would cut rates. Today, May 12th, we have an 88% chance the Fed will not cut rates. What does this mean? The Fed is much less likely to cut rates. That's signs of a strong economy. That's confirmation of the next possible bull market. How about the Treasury market? We go back to March 3rd. At the time, the 10-year U.S. Treasury bond paid a 4.16. Currently, 4.45. The higher yields translate into the expectation of a stronger economy. The Federal Reserve is less likely to cut interest rates. That's also signs of a possible market. That looks good. How about the VIX, the volatility index? That's otherwise known as the fear index. That goes up when the stock market goes down. That big spike, that was a tariff crash in March and April. Well, notice on March 3rd, the VIX was at 23. Now it's at 19. A lower VIX shows less fear, more complacency, more evidence a bull market could be coming. However, there are also signs of a bull trap, a reversal heading back lower. For example, take a look at gold. On March 3rd, it was at 2,900, closing today 32.27. Now, gold doesn't go up during strong economic periods. In fact, gold is another fear gauge or a gauge of, uncertainty within the market. The fact that it's significantly higher than it was on March 3rd, that first day of the breakdown, that's not a good sign. How about crude oil? Crude oil on March 3rd, that was $68 a barrel. It's now 62. Crude oil also acts as a proxy for demand, a proxy for economic growth. In other words, during a strong economy, well, we use more crude oil, there's more manufacturing, travel, commerce. But conversely, as crude oil has been going lower, many economists anticipate this is a sign of a weakened economy. Now, what about the economy? Well, one key number we watch is the CPI, the Consumer Price Index. That's a very popular measure of inflation. Well, currently it's at 2.4%. A month ago, it was at 2.8%. In fact, this past month's reading is the lowest low we've seen since really September of last year. Why is this important? Because we have CPI coming tomorrow on the economic calendar. The consumer price index will be released. Now, this is a very important number. Many analysts expect a hot inflation number as a result of the tariffs and the threat of tariffs. Well, if this number comes in very hot, the Federal Reserve is even less likely to cut interest rates. Maybe we'll see the bond market yields and the Fed funds futures move up even higher. Conversely, if this is cool, well, maybe we'll receive, lower bond yields. We'll see lower Fed funds futures, higher probability of a rate cut, maybe weakening stocks as well. So it will be very telling what the CPI, in fact, tells us tomorrow. Now, vote on our poll. We're going to speak about this. What do you think is the next big stock market trend? Are we going back to the all-time highs, a bull market? Is this a bull trap? Is a big reversal coming? Or do you expect us to stay in a range-bound market for the foreseeable future with no big trends developing? We hope this has been helpful. We look forward to seeing you back soon.